Blue Apron says it's looking at strategic alternatives, including a merger, raising funds, or even selling itself. So Blue Apron, it's been such a struggle from the beginning, Baker. Overall, they had a disastrous IPO. They even did a reverse stock split, which we're seeing now. BBBY, Bed Bath & Beyond, also
down
doing
over the last year.
Yeah.
It's $3.53 a share for Blue Apron
Just
right
remember,
now.
though, the excitement when this company first launched. The concept of millennials who don't like to cook as much. They don't want to necessarily eat out as much. They want to have this kind of mix of being at home and also cooking themselves. But let's bring in a guest now to discuss specifically. Emily Flippen is an investment strategist at the Motley Fool. Emily, great to have you with us here today. Blue Apron, the struggles are real, but what are their real options at this point?
Yeah, Blue Apron is out of a lot of their big options. When we go back and we look when Blue Apron initially IPO'd, the value proposition for this company was that they were going to revolutionize the way that the average person consumed food. They were going to change the grocery store dynamic, change the going out dynamic, and millions of consumers were going to be getting Blue Apron delivered to their doorstep every single week. And that's simply not been the case. So now that Blue Apron is dealing with this new reality, seeing their revenues fall, seeing their consumers fall, and in making a strategic decision to focus on just going after that small group of niche but profitable customers, it doesn't make sense for them to be a public company anymore. So it makes sense that either this company is going towards bankruptcy or more likely this company is going to be brought private by a larger one.
Emily, did Blue Apron just not anticipate the saturation in this business? Did they not expect that every other company out there, from grocery stores to other places, would make their own food delivery kind of kits available for everybody else that would then saturate the entire market?
That's been part of the problem. A lot of big chain grocery stores have their own offers, just like Blue Apron, but these are loss-leading businesses. That means they're not really making money on them. They're just trying to bring customers in the door. So I think the bigger problem was the fact that Blue Apron has been operating in what is an extremely low margin business. It is very hard to deliver food, which is a perishable item, profitably and sustainably, and that's what they've been struggling with.
And it was just hard for them to create that loyalty after offering so many discounts, promotions to acquire customers. But if they were to be taken private by a larger entity, acquired, merged, whatever it may be, what would that then allow them to do? You mentioned maybe becoming more niche, focusing on higher end customers, offering higher margin products. What would be the path forward in that case?
Yeah, I think there's a lot of companies that it actually may make sense for an acquisition of Blue Apron for those companies. One of the ones that I think comes to mind is actually Costco. Now, that might sound a little counterintuitive, but Blue Apron had a deal with Costco 2 years ago where they were stocking Blue Apron in their own shelves, and Costco doesn't have anything like that. For a company like Costco, it may make sense for them to acquire Blue Apron because it brings those customers in the door. They get that upfront subscription revenue, which is what Costco is really going after in the first place, while also allowing Blue Apron to really focus on their target markets. That could exist as Blue Apron is today, or it could simply exist within the walls of a Costco.
Are there any signs that Blue Apron's expansion into other things, like let's just say pantry items, kitchen tools, wines, all these other sorts of things in addition to the food, are those paying off for them?
Some of them are. I think wine is a really good example. That's a much higher margin business. They actually go direct to consumers with that wine, and it's exclusive to Blue Apron. So that's a good example of something that people will naturally pay up for as part of a premium Blue Apron experience. But they need to be careful because expanding into homeware is also a notoriously low margin business. So what they should be trying to do is expanding into the higher margin areas, making that food delivery not cheaper, not doing it with promotions, but more of a premium experience that attracts a more premium audience, and just acknowledging that their customer base is much smaller today than they envisioned 5 years ago.
I want to go back to your hypothesis of a Costco partnership or a Costco acquisition. Is being in a physical brick and mortar location more advantageous for Blue Apron, where it's just a part of a person's regular grocery trip, instead of trying to do this with delivery? As you mentioned, that's even more costly. That's even lower margin. Is brick and mortar the path forward for Blue Apron versus, say, in Amazon acquiring it, for example?
I think there's a very real possibility that that is the case. We see a lot of food delivery services, for instance, who don't have brick and mortar locations, really struggling to do delivery on a large scale while retaining profitability. Grubhub comes to mind. Those companies are the ones that are going to struggle moving forward. So Blue Apron, having been in business as long as it has and having to lose as much money as long as they have, I do think that taking advantage of the scale and the distribution associated with a larger retailer would be the ideal way forward for a company like Blue Apron.
Are any of these Milka companies going to be able to scale without a large-scale partner or even an owner, whether it's HelloFresh, Gobble? There's so many of them now. In the delivery space, we're seeing consolidation, potential acquiree candidates, Postmates, Uber has been discussed in the same sentence before. Can these even exist on their own?
I'm not sure about the answer to that question. I really want to say yes when these other companies start to fall out of line and your options become more limited. But I think more realistically, the answer is no. Even in the ride sharing market where we see an oligopoly between Uber and Lyft, they're still not able to operate that business profitably. And that comes down to, again, low margin delivery businesses are extremely challenging to take on a large scale. And when you have the scale that Blue Apron once had and you're still not able to be profitable, that does not bode well for your ability to continue that for years into the future. So I think physical retail could be the silver lining for Blue Apron moving forward.
When will margins look actually better here, Emily, for these kinds of companies? Is it going to be when we have autonomous delivery, when we have delivery drones? When are we going to see food delivery and meal kits actually see those margins?
I think that the dream of autonomous delivery, autonomous driving is still a ways off. I think what needs to happen is these companies need to express more pricing power for the consumers that are willing to pay up for a Blue Apron box, to pay up to take a ride somewhere versus taking public transportation, to pay up to get their food delivered as opposed to going out to get it or cooking it themselves. These are the businesses that people have become accustomed to being cheaper than they probably should be in the market today. So these companies, Blue Apron included, need to raise their price point, improve the experience, and that's the only way they're going to improve their margins, at least over the short term.
That's Emily Flippen, investment strategist at the Motley Fool. Emily, thanks as always for your time.
Thanks for having me.